Hi everyone, Dave Burroughs here again from Long Burroughs Insurance Brokers, here with Mark to follow on from the first video and look into the D&O world a little bit deeper.
Hi, welcome to Governance Bites. My name is Mark Banicevich, and as you just heard today, I have the pleasure again to spend some more time with David Burroughs. David, thank you very much for your time. I really appreciate it.
No problem at all.
We talked last time about a bit of a high-level introduction. I think you introduced it as D&O 101. Maybe today then as D&O 102, just digging a little bit deeper. So a few more questions for you. A starting point, who are some of the common providers of D&O cover and this sort of insurance around New Zealand?
Okay. Well, pretty much every intermediary operated insurance company will write a D&O product. But most of them will have like different appetites. So that's probably the best way to say it. So everyone will write it, but it depends on the particular outcome that you're after. Mm-hmm. So for the publicly listed companies, you've got your international insurers like the Berkshire Hathaways, the AIGs, the QBEs, the Very Liabilities. Those sort of companies will, and Chubb, and they will write these policies for those larger operations. Looking for the more mid-market area, and then talking more management liability suites is probably more of their sort of sweet spot. The NZIs, the underwriting agencies like Delta and Jewel, and other sort of smaller players will provide some capacity. But again, it's probably better to describe it as what capacity do you need, because the larger operators will provide greater capacity than the smaller operators. So there becomes a strategic choice depending on what the company is, what they do, what industry, what jurisdictions they're operating in, and all those sort of things, which I'm sure we'll get into shortly. But
which is, again, another reason why it's very important to get advice on this topic, rather than just ring around some insurance companies and say, can I get some cover?
Correct, yeah. There's a few moving parts to this, which you'll see.
What are common policy limits for D&O policies?
Oh, look, it varies, right? But for most small businesses, you'll be looking at a $1 million cover for damages, and then there'd be an equal $1 million limit for defence costs is pretty much your standard piece. Mm-hmm. Then it all becomes, it's not really a number you can say for each person, it's for each company. It's a horses for courses approach. If you're a publicly listed company, you'll be looking at $50, $100 million of cover, depending on which jurisdictions you are. Those that are dual listed with Australia, for instance, will certainly be more than 100 million as a total policy limit. But those in New Zealand might have 50 million. It depends on what it looks like. And even then, is it relatively closely held, a publicly listed company versus a very broadly listed stock as well? So you got to think about your position in the market as well before you sort of start putting a number to it, if you follow.
What are the risks, and particularly in terms of the magnitude of those risks? Yeah. So different industries presumably would want different cover levels as well, because some industries would have much higher litigation risk than others.
Yeah, and there's more of a regulatory oversight on some industries. Mm-hmm. So you'd be taking higher limits on those sort of things, because you've got a greater propensity, I suppose, for a regulatory investigation or something along those lines.
It was interesting noting the change that happened to PI cover in particular in our space in the insurance broking world, or the insurance advice world, when the new regulations came in force, because as we talked about earlier about lifting the bar of quality of those businesses, and so you'd think the risk would actually reduce, that bad things would happen, but with the regulatory power in play now, the liability is a lot higher. Yeah. So the cost of that insurance went up quite a lot, didn't it?
Yeah, it did. It all comes into play a little bit. And probably just to finish that little section off, is that even if you're looking at setting it, if you're a board of 5, you'd probably want to be aiming for $1 million worth of cover for each director. So it's another way to kind of maybe get a sense check of what you think is fair. So that might be a $5 million limit with $5 million worth of defence costs. It could be a total $10 million policy that might be deemed appropriate. So it's just a little way of sort of,
Do they tend to be aggregate cover amounts, or do they tend to?
They are, yeah. They're all aggregate limits, and the defence costs are obviously shared with everybody as well. So it's not $1 million for each director. It is a $5 million pool potentially that will be dispersed depending on who needs it.
And that's per policy period, not per claim.
Correct. Yeah, per claim and in the aggregate. So that means that if it's $10 million, you got $10 million for this financial year, but it can be multiple claims within that $10 million but it doesn't reset.
Right, and so if you have a claim that bridges multiple financial years, that would also be limited to that $10 million as well?
Yes, correct. So if the claim relates to this financial year, then it will be this policy that responds.
Right.
The policy will reset for the next financial year, but it won't add to that current claim afoot.
Right, okay. That makes a lot of sense. Do policies tend to have an excess for claims?
Side B does. So where the company is being reimbursed, there is an excess that applies to that. So that could be anywhere from 10 grand to 100 grand, depending on what the negotiation point is, because that will have some influence on what the premium is, because there's more of a self-retention there. Importantly, though, Side A has no excess. So this is where the individual directors have personal indemnification, because the company can't reimburse them or will not defend them. There is no excess payable on that. And the Side C securities claim, there's always an excess on that, depending on the security.
That was a question that kind of arose for me last time. You say that Side B is a policy that covers the company for reimbursing directors for their costs of these sorts of things. Side A reimburses the directors directly, or covers the directors directly?
Covers the directors directly, correct.
Why would a company not just say, use your Side A?
Well, they've got an obligation to indemnify. And so the ability for them to not indemnify are relatively limited. So, and if the company, of course, you want your directors to be indemnified, because they are effectively the key management of the company. So they should be aligned to that fact. But it's only where they can't do it because of insolvency, because of breach of good faith obligations, or other legal reasons why they can't indemnify. Then that's where Side A comes into it. It's the same limit. It's just a different trigger in how they put it through.
So it's important for a company to have both Side A and Side B.
Every D&O policy has Side A and Side B. It is just the way it's structured.
Right.
It just depends on which tower is triggered effectively.
Right. Okay. Yeah. Oh, that's great. That makes a lot of sense. I think that makes a lot of sense, because I was thinking, as I say, why would the company not just say, well, use your Side A policy, we're not paying anything? But it's a bit like having a car accident where you claim on your insurance, but your insurance company then goes for the other...
Subrogates against somebody else.
Yeah. And in the case of D&O cover, the Side A directors would be making a claim, and the insurer would then be saying, okay, well, we'll cover you, but we're going to get it back from the company you work for, and that's why the Side B kicks in. So you have to have both forms of cover in the policy. Yep. Right, that does make a lot of sense. Are there optional features on D&O policies that directors should be aware of? So I definitely want that option, I definitely want that option in place.
Yeah, there are. I think it really comes down to those. Extended reporting period is probably the biggest one. We talked about in the last episode around run-off cover and the claims made in cover. So I think that's a key one to really consider. The other one, it's probably more important what you should be looking into some of the exclusions, I think, rather than what you want onto it all. Because in growth companies, when you're doing capital raising, it's probably a key fish hook here that the D&O policy doesn't cover liability arising from misstatement in a prospectus. We need to seek that cover specifically.
Which is Side C.
But not Side C, no, that's more of a regulatory... This is just in a capital raising scenario.
Yeah, right.
That it won't pick it up automatically. We'd have to apply to the insurer to say, hey, can we have some prospectus cover under the policy, and there'd be additional premium paid. So that's something that if you are going to be going through a capital raising process, then you want to make sure you have got not securities cover, but capital raising cover on the policy.
Right, okay, so it's separate from your securities cover that you were talking about.
The alternative is to go and get a prospectus liability policy, which is a totally different policy. And those are generally put in place for when you're taking a company private, when you've got a big prospectus that you're going to list. But if you're just raising with habitual investors and other investors, then you want to have a chat to your broker and look at that capital raising endorsement being put onto it all.
That's really interesting, because there's a risk there, a real risk when you're making an offer of misleading and deceptive conduct and those sorts of things that exist under the Financial Markets Conduct Act. So you'd certainly want some cover there. And also very interesting that it seems to be called prospectus cover, where we don't call those documents prospectuses in New Zealand anymore. The name has changed. So
we call them POSI for short. So it's probably just the acronym that we use that we sort of carry over and POSI. Yeah.
Okay.
Yeah, anyway, so I think that's the key one there, is it can trap a few people. And again, because most capital raising is probably done with private citizens that are we used to call them habitual investors, but people that have got
wholesale
investors now, then the regulations don't necessarily provide too much protection for them. So it's probably less of a concern if you're doing it with those.
Yeah, it's the retail investors.
It's the retail investors that you have to put your, there should be some warning bells going off there.
Yeah, absolutely. Right. Okay, so the key thing to draw out there is if you're doing a capital raise, particularly that involves retail investors, and you have got a registered offer document in place, then really important to talk to your broker and make sure you get some special cover for that, because it's not included in your D&O cover.
It will be excluded unless we seek that cover to be put into that.
Right. Are there any other fishhooks that directors should be aware of? Any other exclusions and things that directors just really be aware that it doesn't cover the situation?
Look, I think it's common sense stuff too. There's a material change obligation to notify the insurer of any material change. Now that can mean simply a change in control, it can mean change in shareholders at a material level, or obviously if you're making an acquisition and adding another company or starting a new subsidiary, those things are all what we call a notifiable circumstance. Now, failing to do that doesn't necessarily invalidate the cover. It just means that we've got to go back and do some work with insurers to get them comfortable. So I guess the key thing is that you should be talking to your broker more regularly than not, and if there's any big moves that you're going to make, then it's best to sort of talk that through and figure out what is notifiable and whether or not any cover can be specifically noted to extend cover.
So do you tend to have an annual review with all of your clients on these policies and talk about what's going on in the company?
Yeah, because these things are an evolving contract. Not business doesn't stand still, and so every year it's a good opportunity to review. But I do recommend if there's anything, if there's a big strategic change to the business, then that needs to be briefed and work with the insurer to make sure that it's still fit for purpose.
Right. You talked about customisation before. How are policies customised for different companies, different industries, different regions? What sort of customisation comes into play here?
Look, customisation, most of them will probably be more specific exclusions more than additional affirmative cover. It's if you're a tech company, there's going to probably be more privacy-related endorsements that will come on board. If you're in a heavy industry, there'll be more health and safety kind of exclusions that will sort of come on board. But really, when we're talking about customisation, we're really looking at the wording of some of the definitions that may need changing. It may mean that they have to extend it because the definition of shadow director might not be enough, or we do that. So when I say customisation, it's not as if we go and break it and rebuild it. It's really just tweaking to make sure that something that's grey, we want to have affirmative confirmation of cover. So in a way, we want affirmative cover rather than subjective cover is probably the best way. Sometimes subjective cover is good because you might be able to squeeze something through, but it's affirmative cover that we always seek.
So presumably that's more likely for your big companies than for your SME, your small and medium businesses.
Correct.
Where they'd have a lawyer that would be reading through the policy and saying, I don't like these two words.
Absolutely, yeah. Where legal counsel's involved, that's generally where we see a lot more tweaking of language. For the mid-market and smaller companies, and the coverage is kind of what it is, except we can often negotiate exclusions to be removed if that's really the core risk that we're trying to put in place. Because insurers also have an obligation to make sure the policies they offer are fit for purpose and actually provide cover. So if there is an exclusion that specifically takes out 80% of the exposure, then they're not necessarily doing the right thing.
Yes, yeah, right. A lot of business these days is essentially global, or at least international. Do these policies tend to cover multi-jurisdiction, or are they limited to New Zealand? How does it work if, for example, a company might be a small business that's operating New Zealand and Australia, New Zealand and Asia, or worst case scenario, the US? Yeah,
well, the US. Okay, we'll come back to the US. The policies can provide worldwide cover. It just becomes a negotiation point at renewal. So it's the territory and jurisdiction clauses that we need to focus on. The territory is the one that says the territory is where a claim can occur. The jurisdiction is where a claim can be heard.
Right.
So the territory should always be worldwide if you are doing, internet. Usually it's worldwide is the widest, then it's worldwide excluding the USA and Canada. So North American exclusion, and then you can get down to New Zealand only, Australia, Pacific Islands and that kind of thing. But generally speaking, worldwide excluding the US would be what most policies should have if you've got an international footprint. Now, into the US is a bit more of a problem because we all know how litigious it is, and what you'll find is this is where the appetite for New Zealand insurers will be more limited. So where you might be able to get $10 million here in New Zealand, no problems, getting a $10 million limit that will cover the US may be a little bit harder to achieve. And then they'll probably put more US exclusions in there around no cover for superannuation schemes. They may reduce some of the sublimits that are in place for IP breaches or something like that. So it's always the US endorsements, the ones you have to focus on, because they can be more limiting than they are providing cover.
Right.
So one way to do that is potentially, if you are having a US presence and you're looking to expand that presence, then aligning with an international insurer that has a US presence is probably a good strategic choice to make, because then we can put a local policy in place in the US and build the limits up in the US, which provides more capacity availability, and it's also going to be more of a robust policy response because it's going to be built on the US requirements.
Yes.
So I don't want to scare people out there, but the US is a totally different beast.
Yeah.
And it needs to be taken, seriously and strategically, and it's not something you can just put in place, quickly. It's going to take a wee while to actually get insurers on board, underwrite it in the US, and have a look at that. But generally speaking, if you're just sending products to the US, then you can have the policy responding to the US, no problems at all. It's really only when you've got a company in the United States, plus you've got boots on the ground, and all those key strategic moves you make is when things change to be a little bit more multinational in flavour.
The jurisdiction clause that you mentioned before is an interesting one. So you're then saying that the policy will cover you if the case is brought in New Zealand, but if it's brought to a foreign court, it won't cover you, essentially.
No, it can. As long as the jurisdiction clause is also worldwide, then that's the widest cover you can get. So a claim could be brought in the 5th District of California or wherever it needs to be.
Bangladesh.
Or Bangladesh, depending.
Yes. And therefore that cover would be a lot more expensive. So generally, if you're a New Zealand company and you're writing contracts with your customers, you probably want to have a choice of jurisdiction clause in those contracts to say cases are brought in New Zealand.
Yeah, look, we always advocate that any contract you sign in the US in particular is on your own terms. So you are saying, well, hey, look, we were only going to provide $5 million worth of indemnity. We're not going to provide unfettered, unchecked indemnity language. And we're going to say, well, every claim has to be heard in New Zealand. That's great. But we know that that's not always going to be the way you win business, and insurers know that as well.
Yeah.
So it just means you have to make sure that your territory and jurisdiction align to those contractual obligations, and making sure that we don't miss anything on that.
Yeah, so right.
It's the
and the US
is the US.
Coming back to the US again, it's not just one beast, right? It's a multi-headed beast, being a federal system. It's got legal systems in each state, as well as it's federal.
Well, that's right, and we've all read a John Grisham novel, right, where you've got these ambulance chasers, are out there looking for litigation as their way to live, and you're also going in there against established market leaders, and so they've got unreasonable powers within that industry. So if you're a small New Zealand company going in there, the risk is even greater because you simply just don't have the financial assets to take on $1 billion behemoth. And there's been a recent case of a software company in New Zealand that had to be liquidated because of an argument around potential IP and copyright infringements, where they just simply didn't have enough ammunition to go and fight a market leader. So the US is it's the holy grail because we know the economy.
It's a massive market and a big economy.
But it's risky and it's more complex. Risk. And from an insurance perspective, it's not an easy off-the-shelf product you have to buy. You have to be strategic on who you align with, how much capacity you buy or you can afford, and then looking at which states you actually focus on as well, because Delaware is well known as being the home of most companies, but Texas has got other tax benefits for other companies. So that federal versus state versus state kind of setup is
single state setup.
Get advice from lawyers, accountants, everyone you can, and then the insurance will come part of that.
And that would apply equally to your public liability cover and things like that as well, right? Which would be even more scary for the company itself.
Well, that's a whole different topic. But you're right, that's personal injury and people. So it becomes very much a heightened exposure. And for directors, that should be important because we've got obligations to make sure that our staff are safe at work. Directors would be dragged in if there's death or bodily injury in any function in the US as well. So, making sure that you've got an overview of what the insurance's requirements are in those jurisdictions is also a big director obligation. And so they'll have interest in making sure those policies are put in place correctly, and are of significant capacity to cover that exposure.
Taking a little step back, how does the application process work for this type of insurance?
Oh, look, it starts as like most applications with a proposal form, and also accompanying documents such as sometimes the constitution and almost every time copies of the financials. Your broker will work with you to figure out the best way to put forward the risk, and that may be business plans, it may even be meetings with a director or CFO, depending on what the complexity and scale is, right? So, but 9 times out of 10, it's proposal form, financials, and maybe a bit of supporting information around what the business strategy is, and then the broker will write a submission and then talk to the underwriters and figure that out.
Constitution, I think, would be a key one, because that's where a lot of the liability would sit for directors. Would be what's set in the Constitution. Okay, and the claims process. How does the claims process work?
The claims process works in the fact as soon as you become aware of a claim, we call that a circumstance, something that may give rise to a claim. That's when we notify the insurer. The insurer will consider that and figure out at what point they will appoint counsel. And then once the counsel is appointed, they'll operate and look at whether coverage is affirmed, and also look at the defence opportunities that they have there as well. And of course, with the D&O policy, every director is entitled to their own counsel. So you don't have to share one counsel for the whole board. Everyone's got their own counsel. So depending on, again, the likelihood of the claim being successful or the severity or what's being claimed, how quickly we appoint counsel to everybody will be determined based on need. But effectively, most times, it is just simply you make a notification of a circumstance, it goes nowhere, it's noted, and the insurer's on the hook when and if it actually pops up again. But it's the way. And
is there an obligation on the policyholder to notify as early as possible? And
absolutely.
What happens if they don't?
If you don't, if you should have notified in the current insurance period, and you notify the next insurance period, then generally speaking, if you're with the same insurer, they'll treat that fine. But the problem is that if you do change insurers that year, and you fail to notify with the previous insurer that it should have been, then the current insurer may decline that claim, basically saying, well, we went on risk when that wrongful act was committed or alleged to have been committed. In which case, the other policies have that extended reporting period piece there as well. So there is some safety net there too. But
right.
So it's always important to notify as soon as you become aware of it, even if you think it's got no legs. More notifications, the better in a way.
Right. So it really feels like the choice of insurer is a really important one, and it will become a long-term relationship for the company to in most cases, stick with the same insurer for long periods of time because of these risks of changing insurance.
That's right. I think you've got to treat your D&O relationship just like you would if your professional indemnity relationship as being a partnership with your insurer. It's not a commodity that you want to go and chop and change every couple of years just to chase a bit of premium. Now, premium's important, we know that, and you have to balance that expectation. But our viewpoint is that you want to make sure you've got continuity with your insurer, particularly if you're going into different jurisdictions and making a change like that.
Yes.
That's where the strategy of choosing the right insurer for the right course of action your company's taking is important.
Does it differ in any way for not-for-profit organisations than it does for companies?
Well, it does and it doesn't. They still have the same sort of obligations than they do, just like a trustee would. So the trustee's obligations and the director's obligation aren't too dissimilar in a sense. So all those sort of risks are treated relatively the same. So, but non-profits obviously don't have the money to buy large D&O policies, so they'll be more on a non-profit management liability policy that will be a bit more, watered down in some of those areas that aren't so important. And all of that. So.
Right. Okay. So there might just be not such a wide expanse of cover in order to keep the premium down.
Yeah, correct. It would just be the basic sort of breach of duty and other sort of benefits like that. They may not have the assets and liberty expenses, or they may not have the tax liability sort of obligation. Those sort of things that are more tailored for a corporate setting.
Yes.
They may just sort of have those watered down, or they may even have smaller supplements of cover. Where it might be $100,000 compared to $500,000, depending on what it looks like. Right. It's just horses for courses again.
Okay, right. One final question for you. You've, in establishing this company, you've got your own board of directors, and so what's the best governance advice you've received?
Best governance advice I've received? It's probably to stop and think. Is probably what sort of resonates with me. In the early stages, you're hungry, you want to grow, and you've got great ideas, but you just have to sort of wait and sort of figure that through and seek advice. We've only recently established a advisory board, which is probably one of the best things that we've done, because then it brought accountability and we had time to sort of question decisions. Whereas for the first 5 or 6 years of our being, we operated relatively freely. Thankfully, my other business partner and I agreed on most things, so it wasn't such a problem, but it's really having that accountability and stopping it to think, I think, is probably how I'd sum it up.
Cool. David, thank you very much again for your time. It's been really interesting to cover this topic. I've greatly appreciate it. Look forward to chatting again soon, and see you next episode.
Thanks very much.
Thank you for watching this episode of Governance Bites. We have more episodes on YouTube and your favourite podcast channel, where I interview directors and experts on various topics relating to boards of directors and governance. We'd love to see you back, and please like, subscribe, and share the videos and podcasts.